Hi, I'm Pattu from FreeFinCal, and that's right, rupees 1000 in 1980 is only worth rupees 68 in 2019 because of inflation, and this is how we can protect our money from the demon of inflation. So, this is a talk that I'm going to give at the World Bank next week in a couple of days, and I'm looking forward to that. So, here are just a few slides from it, just 5-6 slides from that. If you're interested, I'll probably tape a separate recording of the full talk and put that up. So, I usually ask this question in my talk. So, suppose you are traveling on a road and you hit a fork in the road and you have two paths. So, you find out from people which way to go, and they tell you that if you go this way, the path will be smooth, but it will not take you where you want to go. It's a guaranteed failure. But if you go this way, the path will be difficult, but there's a reasonable chance of success. Now, which would you choose? So the obvious choice would be this path, right? Because you have a reasonable chance of success. Now, the cost inflation index is a measure of, is one of the measures of inflation published by the Government of India. It is used for actually calculating the long-term capital gains tax on assets which qualify as long-term capital gains, on gains from assets which qualify as LTCG. So the cost inflation index is proportional to the consumer price index, and the cost inflation index had an original base of 100 in 1980, and in the financial year 2016-17, the base was changed from 1980 to 2000. So what you see here is the cost inflation index, where I have actually merged the two data into one single curve, and so I've taken into account both the bases. So the cost inflation index tells you how much it's a measure of inflation in the country, and if you use this data and you can actually reverse it, and you can show that what was worth 1000 rupees in 1980 is actually worth 68 rupees because of inflation. So, well, inflation is a bit of a funny name, because to inflate means something getting bigger, but here money is actually getting devalued. In Tamil, it has got a very nice meaning, and it's one of my favorite words. It's called Panaveekam in Tamil, so it means money becoming weaker in Tamil. That's actually the correct meaning of inflation. So 1000 rupees if you can revert it around, so you can say that 1000 rupees in 2019 was actually 12,000 rupees in 1980. So what was 12,000 rupees is now gone down to 1000 rupees, or you can say it either way. And over this 37 years, this is a year-on-year approximate averaged out inflation of 7%. And this is only the reported inflation. Even the reported inflation is 7%. Please recognize there is a huge disparity in India between what is actually reported as inflation in prices and what is actual inflation in the expenses. And the big difference is because these indices that are published by the government do not exactly take into account inflation in service costs. So if you take the price of petrol from 1990, this was published just a few months ago. Today the price is around 73, 74, 75 roughly. Petrol and diesel prices are not too different now, I think. So this is just petrol and diesel roughly is anywhere between 6 to 8% inflation over this period of 28 years. And in the next 15 years, if you project this forward, it's going to be, petrol is going to cost, after 15 years, it's going to cost just about 200 rupees. Now, the point that you should keep in mind is whether it is a big corporate company or whether it is a small tea shop guy, practically every business depends on transport, directly or indirectly. And if the cost of fuel is going to increase, just the cost of fuel alone is going to increase like that, then for the business to be profitable, the price of the product or the price of the service they are selling should be increasing at a much bigger rate. Otherwise, they will not be in business. So, if that is the case, when we are using those services, obviously our inflation will be high. So, even if there is no lifestyle change, even if there is no lifestyle creep, the actual inflation will be higher than what is reported. And let me come back to this. So this is the inflation in my family from 1995 to May 2016 approximately, and it's about 8%. Look at the inflation in vegetables. Look at the inflation in paid help. There's really no regulation on these things. And in vegetables, in the case of vegetables, if it rains too much, vegetable prices will increase. If it doesn't rain at all, vegetable prices will increase. So it's a big problem, right? The price of tea is unregulated. They can increase to anything. I'll come to that. The price of education is unregulated. Cost of education is unregulated in India, unless it's a government institution. Medicine is practically unregulated. Right? Nobody goes to government hospitals unless you are really out of money. So, over the last 37 years, CII inflation has been 7%. If I keep CII inflation as 5%, just 5% over the next 30 years, people say, oh, India is a developing country, India inflation will become lower and so on. 1 crore today will become 21 lakh after 30 years. So if you are holding a 1 crore term insurance policy, if you die after 30 years, it will be worth only 21 lakhs. Of course, what is the solution for this? The solution is not to keep buying more and more term insurance policies. That's stupid. The solution for this is to grow your net worth at a rate much higher than inflation. That is the only solution. And this is my favorite example. I have a video on this about the lessons from a cutting chai. So a cup of chai on the road costed about 50 paisa to 1 rupee in 1990. Today is 10 rupees. That is something like 11-12% inflation. 11-12% because it's a service, because the tea shop guy has expenses. They have to buy, they have to source milk, they have to source coffee powder, tea powder. All those businesses will depend on petrol. Again, it's a very complex situation. That's why actual inflation in services is that much. So you cannot delude yourself saying I will use only 6% in my calculation or 7% in my calculation. You have to keep inflation as high as possible in your calculation, as much as you can afford. And please recognize this 8% inflation for my family is for a very frugal lifestyle. We do not eat outside. There were no mobile phones there, just little bit of cable expenses during that time. Today people change mobile phones every 3 to 5 years. They buy laptops. They change their. We never change TV for 20-25 years. But if you have a LED TV or whatever, that'll get. I mean, they'll have some spots or something, like whatever. I don't know. We don't have one. We have only the old LCD TV. So it's going good. So the thing is that if you buy the 1 lakh TV, after 5 years you will buy a one more. So that's not factored in here. If you factor that in, look at what the inflation will be. It's astounding. It's mind-boggling. It's really scary. This is what should scare you. Not the videos that I published yesterday about a risk in SIP. No, you cannot expect return. You should be worried about this. So this is what will happen if we do not take care of inflation. We'll be running in the same spot, chasing after money, but money will just get devalued because of inflation. So you got to be careful about that, and you got to safeguard yourself. So what is the need for? So obviously you know what I'm going to say as a solution for fighting inflation. Invest a good chunk of your money in equity. The reason is very simple, not to get high returns. The reason is, today the price of cutting chai is 10 rupees. After 20 years, if you inflate it at about 10% roughly, it will become 60 rupees after 20 years on the street. So in order to, let's say you have 20 rupees today, 10 rupees you drink 1 cup of tea, another 10 rupees you invest. If you are going to get a 10% return after tax on that 10 rupees, you can drink a cup of tea for 60 rupees after 20 years. If you say, I don't want 10% return, it's too risky, I'm going to settle for 7% FD kind of return, then you must invest 18 rupees and not 10 rupees. That is the difference. If you choose a slightly higher return, if you choose an asset class where you have a chance, not a guarantee, chance of a higher return, you invest less, which is manageable. If you want guaranteed returns, you have to invest more. You can beat inflation either by getting a slightly higher return or by investing more in a fixed return. Most of us cannot invest more, and therefore there is simply no alternative, as P.V. Subramaniam calls it, TINA, than to invest in equity. A significant chunk of our money in equity. Wait a minute. Yesterday, this guy said, don't expect any returns from mutual fund SIP. Day before that, he said he showed results from SIP and said SIP of GSP small cap and said SIP started from 1 month to another can differ by a huge amount. Today, he is saying invest a huge chunk in equity. What is wrong with you? Like people called me yesterday, I think something is wrong with me. Well, I've been saying the same thing. People have lost. I don't know why investors have to have extreme reactions. When I say don't expect anything from equity, that does not mean don't invest in equity. For the record, 60% of my net worth is in equity, mutual funds. I do not expect much returns from equity at all. I manage my risk. I have been saying the same thing again and again. People have missed that. They see what they want to see and assume what the guy making the video is either right or wrong. Let me explain with this slide. So if you are going to be a saver, like invest in FD, LIC policy, RD, gold, long term, you will get 5-7% return after tax. The amount invested will be safe, not in gold, but in at least others. But after a long time, the amount, as we have seen, will lose money due to inflation. The value will lose value due to inflation. So the option is to invest. The stock market via mutual funds or direct equity or in active mutual funds or index funds is a decent way to try and beat inflation. You can aim for after tax return of 10% from equity, provided you have enough of it and you know how to manage it. The amount invested will fluctuate, whereas that's the risk here. But it has a chance of beating inflation if managed right. This if managed right is what I have been saying again and again and again, which nobody bothers to see. Manage it right. Reduce risk in your portfolio. Rebalance every year. Have an asset allocation. Step down the asset allocation in a gradual manner. Have a goal. Have a clear target corpus. Find out how much you need for the goal every year when you do the portfolio audit, and make sure you gradually build the fixed income allocation so that you have money as you head near the goal deadline, more and more money in fixed income. That is what I've been saying, manage it right. If you want, you can do tactical asset allocation as well to reduce risk. It's up to you. People never see this managed right part and they say, oh, this guy is against equity, this guy is against mutual funds. He's demotivating people. Well, whatever. So, there's no choice. You have to do it like this. And that is what I mean by this. If you choose to be a saver, the path will be smooth because most of us, because the returns are fixed, it will be a guaranteed failure because most of us cannot invest enough. If you choose equity, the path will be difficult, but there is a chance of success if we manage the risk right. So, that's what I wanted to say in this video. I will reiterate, I am not saying do not invest in equity. I am saying invest in equity. My own money is invested in equity. 60% of it is invested in equity. I am only saying learn to manage risk. Do not treat your mutual fund investment or mutual fund SIP like a LIC policy where you have to pay premium every month. That is not how equity works. That is what the AMC fellows and the advisors want you to think. That is bullshit. You have to actively manage the risk. If you do not know how to manage the risk, Learn how to do so. It is simple. There are plenty of resources in my own channel, elsewhere, or at freefincal.com. Please spend some time learning instead of saying I'm confusing people. That's not going to be productive for you. I don't care. So I'll catch you in another video. Bye.